Nalu FM Finance Podcast. Insight into the financial markets.
What we're trying to do is effectively harness the best of both worlds. The risks that the investors may be willing to take and banks being able to provide better pricing as a result.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.
I'm here with Ed Senior, CEO and partner of Fortem Capital. Thank you, Ed, for taking the time. I would like to start with, to talk about the trends in the structured product space that we've seen over the last 18 months. Lots of things have happened. Lots of market volatility was in there over time. But what have been sort of the trends that you have seen in the structured product markets lately?
Good morning, Stefan, and thank you for the invite and thank you for your time. I think with regard to trends in the last 18 months, I'm probably going to speak more specifically with regards to the UK professional investor market, although I'd probably say that extends also to the European market to some extent as well. Although with no disrespect to my UK counterparts, I would say that the European investors tend to be slightly ahead of where UK investors are. But it's all a similar theme. I think the trends that we've seen over the last 18 months have been in structured products. Again, we're still talking about the same types of structured products, and that is the defined return investments, known by lots of different names and acronyms, auto calls, digitals, reverse bonus certificates, so on and so forth. But in essence, they're derivative-based investments, ordinarily linked to equity indices like the FTSE, the Eurostoxx, the DAX, the CAC, the S&P, so on and so forth, and or single stock underlyings. In the UK, it is predominantly index-linked structures, and very specifically auto calls.
From a trend in a sense, we had COVID, we had big volatility spikes in certain parts. How has it changed what happens in the structured product model in the form of payoffs or underlyings?
Good question. So I think it's well known that March 2020 was the month when COVID really kicked in with regards to markets specifically. I think peak to trough from end of February to latter part of March, equity markets, S&P, FTSE, Eurostoxx were down in excess of 35%. With that, you saw massive spikes in implied volatilities. So what that meant was, long story short, was that dividends within the derivative space got smashed considerably. So what's that? What does that mean in terms of trends? I think, generically speaking, what we've seen in terms of trends, both in terms of innovations and payoffs, has been around banks mitigating some more of the risks associated with the products that they offer. And what's key for an organization like Fortem, who provides structured products individually and funds to the market, is to effectively work with the banks and harness some of those cost mitigations or innovations and pass those benefits on to the end investor, i.e. what we're trying to do is effectively harness the best of both worlds. Risks that the end investor may be willing to take and banks being able to provide better pricing as a result.
And what are the features that the banks introduced for that I presume either on the payout or the underlying or...
Yeah, I think maybe just breaking it down between payoff and underlying. As I mentioned, I think most of the innovation over the last 18 months has been with regards to underlyings. In terms of payoff, I suppose the two or three main things are with regards to these structured products or the risks that they carry are correlation on what we call discontinuity risk. So the discontinuity risk comes from the digital payoff that's inherent within these structured products. And the correlation risk comes from the fact that a lot of these structured products that get offered by the banks are linked to underlying a basket of underlyings, whether it be a basket of indices or stocks. And a lot of the structured products, in terms of the payoff, are linked to what we call the worst of performing underlying within that basket. So what that typically means, if you have a basket of, say, 2 or 3 underlying indices or stocks, the payoff at maturity is observed on the worst performing underlying index or stock over that period, rather than the basket or the best of, for example. What that effectively means is that the banks carry correlation risk on their books, and the discontinuity risk is regards to the digital payoff at maturity, as you've said. So in terms of payoff, the payoffs, couple of features I'd probably mention then is that with regards to discontinuity risk, invariably these structured products have this sometimes referred to as soft capital protection or contingent capital protection at maturity. And what that invariably means is that if you have a product that has, certainly with regards to the UK market, 4, 5, 6 year time horizon, that level of capital preservation is observed at maturity. And what that means is these products can have quite a significant, let's call it payoff or swing in terms of what the payoff of that product is at maturity. Typically, as an example, it could mean that an autocall product or a digital product could have a payoff on the last day that swings between 150% of the initial investment and, say, 50% of the initial investment, if the underlying or one of the underlyings is at or around a very sensitive barrier, so to speak. So one of the ways to sort of smooth that discontinuity risk for the bank is to effectively have that capital preservation observed during the life of the product. And so from an investor point of view, what that means is that every day the underlying index or worst performing underlying index is above a predefined barrier, that locks in a small amount of capital preservation. And that is observed through the life of the product, so that their capital preservation, as I said, is observed during the life rather than only observed at maturity. That works for the client potentially because, again, they're not observing at maturity only, and it works for the bank. They're mitigating some of this significant PIN risk, discontinuity risk at maturity. And then in terms of the other payoff innovation, I would say, again, referring back to that comment I made earlier about the correlation risk, effectively switching the payoff rather than it being observed on the worst performing underlying index or stock, for example, it's observed on the basket, and that relieves the banks of some of the correlation risk. Both of those features and also with regards to the underlyings, which we'll get to in a minute, just means that the banks are required to take less hedging costs. Less hedging costs for the banks means that they can transfer some of those savings onto the end investor, which means better terms for the client.
Win-win.
Win-win, indeed. On underlyings, it's with regards to dividends. So what we've seen is most of the banks and a lot of the index providers launching what we call these fixed dividend indices. And that effectively transfers, should I say, that dividend risk that I mentioned earlier that the banks carry to the investors. And so, if maybe I can give a quick description of what a fixed index is and how that compares to a normal index, so to speak. So, with a normal index, what you have is effectively the on a total return basis, you have the price appreciation of the underlying shares and also the dividends that they pay out. With the fixed dividend index, there's effectively a subtle difference, and that is that there's a fixed amount of dividend deducted from that index on an ongoing basis. So, as an example, the Euro Stocks, we'll use Euro Stocks as an example, has historically had a dividend yield of around about 3.5%. But when you buy a structured product linked to the Euro Stocks and the bank issues a structured product linked to the Euro Stocks, as I mentioned, that is based upon the price return version of the Euro Stocks, which means that you as an investor only receive, or the performance of the investment is linked to the price return of the underlying index. And the bank therefore has to make some projections as to what the dividend yield on that index.
And with products like this, he has to do it the investment bank has to do it out to 5-6 years as the products are so long, which is a lot of uncertainty.
Correct, exactly that. Yeah, a lot of uncertainty, as you know. Invariably, stock analysts tend to only provide forecasts and there's only a certain level of transparency, or if you want to call it that, on stock or company dividends, probably 1 to 2 years, right? And therefore, what happens is beyond that period, banks start having to make projections, forecasts as to what the dividend or implied dividend yield of that index is going to be. And again, backdrop being, a lot of banks got burnt last March, making forecasts on what those implied dividends are. So what, even if it's human nature, but also thrown into that, banks having their risk departments enforcing additional, more conservative assumptions, so on and so forth. The assumptions they make around the future implied dividend yields for the Eurostoxx, for example, are probably below 2.5, which means that the terms that investors can get for structured products linked to the Eurostoxx with a much lower implied dividend yield is relatively speaking inferior to what they received in the past, all other things being equal. So what you can do is effectively say, okay, right, well, instead of buying a product linked to the Eurostoxx conventional index, I'm going to buy a structured product linked to the Eurostoxx with this fixed dividend in there. And again, most of the banks and the independent index providers are quite flexible now in terms of the different levels of fixed dividends you can choose to link your product to. So you could say, oh, do you know what? I've looked at historical Eurostoxx dividend yields and it's tended to be 3.5%. So therefore, I'm happy to have an index that takes out a fixed dividend of 3.5%. Some may say, actually, do you know what? I think that's a little bit aggressive given we're just coming out of, hopefully coming out of the COVID crisis, and therefore we think dividends are going to be a little bit lower. So dividend at 3%, so on and so forth. But the point of it is that you can effectively design your structured product and link it to an underlying index with a fixed dividend that is higher than what the banks are implying with regards to conventional indices. And what that means is, when I was mentioning earlier on about a job for Fortem is to try and identify those innovations around payoffs and underlyings where we can take advantage of banks wanting to transfer some of their risk off their books onto the investor, which translates into better pricing, but also that from an investor point of view, it stacks up, i.e. it's not a risk that we think the banks are just trying to offload and it's to a disadvantage to the end investor. We think in this particular case, as long as you set the dividend at a sensible level and also build your barriers in the product sensibly as well, to refer to you earlier on, Stefan, it can be a win-win situation because the banks have offloaded some of their risks and the investors have got a product and got product terms that are superior to the same product should they have linked it to the conventional Eurostoxx price return index, for example.
I think it's particular because one always has to remind themselves, pretty much in all these products, the products pay out the same thing independently if the index it's linked to went up 5% or 50%, as it is a defined payout. It pays out the positive return of the market is where it is currently, or even slightly below that, depending where you set the barrier. So you don't have to design an underlying that has to go up twice to actually perform this. So, if you're sensible, as you said, you get a lot of bang for your buck.
Yeah, I mean, when you're setting these barriers and designing these products, you're not looking for an underlying that shoots the stars out. You're looking for something that performs, relatively speaking, to the barriers that you've set.
And I think that's why, or maybe you would like to comment on, but the other thing changed in the underlying. Some people went from capital weighted to equally weighted indices.
Yeah, I think you're right. I think that was probably one of the other trends we've seen. Typically, in the past, structured products have been linked to the underlying indices, which are the capital returns, so the FTSE 100, the Eurostoxx 50, so on and so forth. What we've seen is a bit of a trend towards equally weighted indices. So FTSE 100 obviously becoming each stock becoming 2.5% weighted, so on and so forth. And couple of reasons for that, I think, is that from a pricing point of view, it works for an investor because having equally weighted rather than capital return tends to result in the underlying index being slightly more volatile than the conventional. And with a lot of these structured products, the end investor is effectively selling volatility. So selling volatility at a slightly higher level for an equally weighted relative to a capital weighted index translates it into better pricing at the product level, and also from a investment asset allocation point of view, factor, whatever you want to call it. It also allows for the investor to diversify their the factor weights away from growth to value, for example, and vice versa.
Coming back a little bit, I agree with you wholeheartedly on this one. Coming back a little bit to the structured product side as it is currently. You mentioned earlier in our conversation that you use it in your progressive growth funds. How do you approach it? How do you harness this? I presume similar how you help other clients of you invest in structured products, but how do you approach it specifically in the progressive growth funds? And how do you make the edge that you can generate here work for your investors?
Yeah, I mentioned earlier on you can design these structured products or these defined return investments to provide for levels of capital preservation over the medium to long term, and also the potential to provide for positive returns even in negative market scenarios over the medium to long term. So the way we position our progressive growth fund is to provide for, as I said, depending upon the way you look at it, a defensive equity allocation and or an absolute return-like profile over the medium to longer term. So our fund in particular targets a 6 or 7% annualized return over the medium to longer term. So you won't get 6 or 7% every year, but over the medium to long term, that's what we're targeting. Whilst also exhibiting around about 50% of the volatility of the underlying equities to which they're linked. And at the same time, we effectively ensure that the credit risk within the fund is limited to investment grade bonds.
Actually, that is a very big thing. People need to keep that in mind. When you normally buy a structured product, you take the credit risk of the issuer. If you buy it in this sense as a diversified portfolio in a fund, the credit risk is pretty much 99% is government sovereign debt, basically, which is significantly better.
Yeah, sorry, yeah, that's a good point. Thanks, Stefan. Yeah, so we when we launched the fund, we decided that we were going to target a reasonably defensive return of 6%, although arguably, as I said, given where equities are right now, I think it's quite an attractive level of return given what historically equity total returns have been over the long term. I think it's probably been 6 or 7. So if you can buy a fund that delivers on that over the medium to long term and gives you capital preservation on the downside of up to 40%, that's an attractive proposition. What we also include within that is to as you mentioned, to negate the credit risk ordinarily associated with these types of investments if you buy them individually, and that is the bank. So we effectively back the credit with investment in sovereign. So UK government, Singapore government, Japanese government, US government credit exposure, for example, and then so that's the fund in effect. I guess if you want to critique these types of investments or highlight one specific critique of them, that is that over the short term, if there is a significant equity market sell-off like we saw last March, then these products can capture a lot of that downdraft.
I think in its defense, your fund is diversified, so you're not exposed to just on this point with everything on your barriers. And also because a lot of these products are very long dated, the average maturity probably is 2 to 3 years, and there you have quite a bit of time for the market to recover.
Yes, all of that. Plus, we have this portfolio or this allocation to non-equity linked investments.
A question I always like to ask everybody, Ed, is what are your favorite finance movies and why?
One of my top 3 would have to be Glengarry Glen Ross. There's a little bit of sentiment involved in that. Stefan, you will recall many years ago when we were working at the Mighty City Group, you took us to the Everyman Cinema in Hampstead to watch that movie. I'd never seen it before, and I think for anybody that's seen it, they'll all be familiar with the classic Alec Baldwin line, "Always be closing." So, and I think it's one of those classic scenes. Second one, again, sorry, it's probably slightly predictable, but it would have to be Wolf of Wall Street. And then, I suppose, just for a bit of fun, to book the trend, I'd include in there trading places, which, again, I think fun movie, with a bit of a sprinkling of finance-related activity in there as well.
Excellent. Thank you very much, Ed, for taking the time.
Thank you, Stefan. Thanks for your time.
Nalu FM Finance Podcast. Insight into the financial markets.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.